Good morning and welcome to the Home and Finance Show. I am your co-host, Diana Rice Wilkerson with Fairway Independent Mortgage, and I'm your personal navigator through the home loan journey. I remove the guesswork out of the loan process and ensure you get the keys to your new home. If you're buying or if you are refinancing, I ensure that you get a check at closing. If you're in the market for a home, I'd love to assist you. You can reach me at 317-402-5555. And my co-host this morning.
And good morning, this is Janice Bradley with JB Real Estate Consultants, your real estate professional. I help you get your keys at the table, at the closing table. And for sellers, I help put your sold sign in the yard.
A fantastic show planned for you. We are going to be talking about one of the best kept secrets, or I should say one of the most misunderstood loan programs in the marketplace. Mm-hmm. And as you know, if you are a follower of ours on radio or TV, you know we keep it real, straight talk and insider information. I'm pleased today to introduce you to my partner, who is our reverse mortgage specialist on my team, and his name is Planck. Welcome to the Home and Finance Show.
Welcome.
I'm excited to be here.
Good
We get
job.
to talk about one of my favorite subjects.
Fantastic.
Yeah.
So since it's a favorite subject of yours, share with us what is a reverse mortgage.
Well, now you just, see, I had planned audience. I had a little cute opening though.
Oh, she did. Let's time.
So
you can do it.
Okay, so
you can do it.
So we've all heard the term, what the heck?
Okay.
So, but today our topic is what the heck'em. And HECM stands for the Home Equity Conversion Mortgage. And now Janice.
That's a mouthful, though. Oh, you better say that again to me. See, I'm not the lender, so anyway. So okay, I'm not going to say it. Ask him what that word is.
Go ahead. You go ahead.
No, you talked about it. Okay.
What is a HECM?
Yeah.
Great question. So
then we can get to the reverse mortgage. Go ahead,
well,
Rob.
it's really the same thing.
Okay.
So either way you want to say it, a HECM or reverse mortgage is simply a vehicle in which that homeowners can access the equity that they have inside of their house. It can be just that simple. You can think of it like a spigot. A lot of homeowners, especially seniors, we deal with seniors, people 62 and older, they have a lot of equity in their home. And in fact, right now there's about $10.6 trillion of home equity that seniors are sitting on, which is almost as much as all the gold that's ever been mined in the world. So it's an incredible amount of equity. And so what a reverse mortgage or a HECM does, it allows seniors to access that equity for various needs. And so I'm sure we'll talk about some of that.
And let's talk about equity, because many people don't understand what equity is. Mm-hmm. And so can you explain that?
It's the difference between what you would sell your home for, or what your home is worth, and what you owe on it. The difference is equity.
Okay, simple as that.
Yep.
And the reverse mortgage gives you access to it.
It gives you access to that.
Okay, very good.
I heard another saying for reverse mortgage, and that was like to help people kind of feel more comfortable, saying something like reverse retirement, or is how you could use the money. I mean, like most people use it when they're retired, but the mortgage part or the reverse mortgage. You remember how it was
it was Mike Mariani was a guest once, and he said it's better understood if you call it a retirement mortgage.
And that's what we're trying more and more to call it that, retirement mortgage. And so while I deal primarily with the HECM product, we do talk about financing for folks over 62, which tend to be retired individuals. Mm-hmm. We more and more we're calling it a retirement mortgage, because there has been such past stigma to the reverse mortgage.
Yes.
And what we have today really is like the distant nephew of whatever was before. It has changed so much. There are so many more protections and there's so much more guidance now. It is not the product that it was 15 years ago. Mm-hmm. So we like that term, retirement mortgage.
And Rock, so our viewers and listeners, and they've been listening and watching Janice and I for many years. Okay, so we're going to pretend like, and normally on radio it's a live show, so they get to call in. Okay, so we're going to pretend like we're them. Okay, calling you and asking you questions. But what I want you to first address is, why does it scare people? Why does the reverse mortgage scare so many people?
I think in some cases it's just they're not familiar with it, and so there's that trepidation because it's not as easy for some people to understand. A 30-year fixed mortgage is pretty easy to understand.
That's right.
It's a 30-year fixed mortgage. You know each month you have this payment. It's just that simple. With a reverse mortgage, because there's so many different ways it can be set up, or so many different ways in which someone can access that equity, then I think they start to misunderstand it, and then I think they have this fear that they don't really need to have, especially if they're working with folks like us that want to take that time and explain it. And the media has not helped us in the past. They've talked about homes that have been lost to reverse mortgage. There's no home that's been lost because of a reverse mortgage. It might have been lost because of different things. They weren't paying the taxes on the home. They didn't take care of it. They've moved. They went away. Defaults on reverse mortgages are actually extremely low.
Yes. Because
you don't have to make a payment. There's no required mortgage payment. So I think there's just that past fear, and then the fear of just the unknown.
Okay, that sounds good. I can tell you, truly, the reverse mortgages that we do are typically FHA reverse
FHA.
mortgages.
In Indiana, FHA is the primary. The HECM is an FHA loan.
Okay.
And so in Indiana, that's the primary retirement mortgage.
And that is insured or guaranteed by?
It is insured by HUD.
Right.
So the good news is it's HUD. The bad news is that it is HUD. And so what I do tell my clients is that you have to understand HUD's position. HUD wants to make sure, if you're over the age of 62, that we have well educated you on what this is. So by the time any of my clients get to an application, we've gone through what we call the proposal. I've created a special video for them, and we've also given them other educational videos. So there's also some required counseling that HUD has put in place to, again, make sure that everyone understands what's going on. And I'd like to think that by the time my clients get to that point, we've gone through all the questions. We've hopefully eliminated all the fear. In many cases, we've talked to their counselors, whether they be financial advisors, tax professionals, family members even.
Right.
I call them family loans for that reason. So we've tried to prepare them for that, so we've eliminated the fears. But HUD does require counseling by an independent third party. And so most often there's not any questions when they come back, but I actually like when there is. So if that counselor has brought up a question for them and they've come back to me, that's a good situation. We again are going to address it to make sure they're comfortable before moving forward.
So have the ages changed for for them to be able to qualify?
In the state of Indiana, at least one person has to be 62. And that is if you're married. You can be younger than the age of 62 if you're married to someone who is older. Other than that, you can have multiple borrowers that are on it as long as both are at least the age of 62.
Okay. Okay. So what kind of a mindset should a person have that actually wants to qualify for a reverse mortgage? Just somebody just says, okay, just so make believe I'm 62 or over. Make believe. Okay.
Yeah. I'm going to try hard.
Okay. All right. So I am just not sure about this reverse mortgage. My kids say, be careful, but, I see that good-looking man on TV,
Oh, yeah, that's not me.
I like him. I like him. So he kind of makes me feel a little comfortable when he talks about the reverse mortgage. So just kind of share with me, why would it be good for me?
Well, I would tell you first that I don't know that yet.
Okay.
And so part of our process and what we work on at Fairway is to uncover why you would want it.
Okay.
What are you trying to accomplish? A lot of our competition just wants to know, are you old enough? What's your house worth? And do you owe anything on it? And yes, we need to know all those things, but we spend a lot of time interviewing you.
Okay.
What are you trying to accomplish? What are your needs?
I'm 70 plus. I'm 70 plus, and I'm winding down. I do love to travel,
yes.
But I don't want to be bothered with, I do believe I have some equity.
Sure.
I can pay it off.
Right.
I just haven't done so yet.
Sure.
So, why would this be a good thing for me?
I have someone like that right now. This
Okay.
individual we're helping, he has a current mortgage, and so what we're going to do is help him eliminate that required payment. Because with a HECM or a retirement mortgage, there is no required monthly payment. Now, you're still responsible to pay taxes, insurance, and any HOA.
Okay.
So we're going to help eliminate the required payment that he has right now. he will have access to a little bit of more funds because his home is worth enough
Right.
that in addition to paying all the closing costs, paying off the other mortgage, he'll have access to a little bit. And so one of his goals is to travel the country.
Okay.
And so he doesn't want to have to worry about that.
We know each other.
Yeah.
Yeah.
Sounds like you've been talking to him.
Yeah. So then you're going to walk the Appalachian Trail too.
Okay.
Yeah, because that's what he wants to do. No.
Yeah, but
maybe it's someone else.
Y'all just watch him.
But that's what we're helping him do. Is
Okay.
now he lost his wife not that long ago, and so his household income has diminished because of that loss of income. So what we're helping him do is not be burdened with the required payment that impacts that cash flow, because he has less money, but he still has that payment. And that you often see that in when someone dies, the household income changes, but their bills are still the same.
Yes.
So what we're doing is with that lesser income, we're helping that payment go away. Mm-hmm. He's going to access some of that equity so he can pay whatever else he needs to prepare for that trip. And now when he takes off on that trip, he doesn't have to worry that he is spending money that he can't afford to spend. And so he's enjoying his life.
Wow. Wow. So no payment, just pay taxes and insurance.
Taxes, insurance, any HOA.
Yeah.
Yep, have to pay HOA.
I do have the HOA. But what about the interest? Do I pay on interest? I mean, just how does that work?
So that's why it's called a reverse mortgage.
Okay.
So again, talking about the 30-year fixed mortgage, it's easy for people to understand when they look at an amortization schedule, right? Someone will look at their amortization schedule 5 years down the road, they'll go, well, oh crap, I've hardly touched my principal. It's because they've paid all the interest up front on the traditional mortgages.
Right.
With the reverse, we're just going to pay it at the end.
Mm-hmm.
So
Okay.
that's one of the primary differences.
I like that.
Yeah.
I like that.
And the other thing with the reverse, which, Rock, if you could talk a little bit about this, that's a debt that doesn't appear on your credit report.
Because there's no required payment.
Correct.
And so it doesn't. And there also is no debt to income ratio. We do look there a couple years back, again, because this is HUD, and we want to make sure that we are protecting seniors. There were some guidelines that were put in place to make sure that this is financially feasible for them. So we look to make sure, do they have enough money, whether it's just on their fixed income or any other type of retirement income, do they have enough money left over to pay the bills, to pay the maintenance on the house, to pay their cell phone bills and food. And so we do look at that analysis, but there's no debt to income ratio on it.
I know the answer to this, but I want you to explain it to our viewers. So if I have a loan, correct, there is interest. I don't have to make a monthly payment. Well, Rock, just when do I pay this off? When are you guys coming to collect?
When you have decided to leave the house. Well, if that decision was yours, or in some cases someone has passed away. So the loan is not due until the last person has left the home. That could be because they've sold the home, it could be because they've passed away, or it could be because they've moved into some type of facility with no expectation of returning. So then at that point it does become due. Now that doesn't mean someone's knocking on the door and saying, you've got to pay me tomorrow. Yeah. Most often, or not most often, but oftentimes we're talking about death. And so we will find out that the last person has passed away. And so when that happens, then we will contact who's ever responsible and say, hey, your mother has passed. What are your intentions with this home? And so what we really want is for you to be in communication with us and say, well, our intentions right now are to kind of clean it up and we're going to fix it up, and then we're going to talk to our favorite realtor about putting it on the market. That's all great. And we're going to give you up to a year in which to make that decision. It's a 6-month period, and then if you still haven't made that decision, then there are 2 90-day periods. So it's very friendly in that regard. So you owe it when you either have moved and it's no longer your primary residence, you've moved into a facility with no expectation of coming back, or you've passed away.
Excellent.
Yep.
So there's no burden on the mind.
No burden.
So that's one of the things I think in terms of the mindset, the borrower, the owner of the property needs to understand that no one is going to they don't have a point in time in the future when they have to show up and pay this debt off.
Well, that's a good question as well. The term on this is just somewhat what we've already described. The term is either you're no longer living, you're no longer living there,
Right.
or you turn 150. We haven't run into the 150 yet. That would be great someday when we do that. But it's not a 30-year fixed rate. It's not a 30-year term. It's not a 20-year term.
Okay.
It's for as long as you're living in that home as your primary residence, or you've
Wow.
decided to sell or
No
you've left the
term.
home.
No term.
There's no term
That ought to
on it.
make people feel a little bit more
Correct.
comfortable.
Exactly.
I would think.
What about if I'm married and I'm 62, but my spouse is 50?
These are great for that type of situation.
Okay.
So what happens with that is again, oftentimes that older individual is one who typically has more money too, more income. And so a reverse mortgage or a HECM or retirement mortgage is a great way to protect the younger spouse. So in the event of the death of the older one, which is often the one that has the most income. So now that elder spouse doesn't have to worry about leaving the younger spouse with that mortgage payment and less income. And so in the past, there were some changes have been made with HUD that now there are some protections. So if the older person has passed away, the younger one is not kicked out of the house. They can still live there without having to make any other payment other than taxes, insurance, or
Wow.
HOA. Now there are some different nuances. If we do know if there was money still available, what we'd want to know is, and when we get this call, my husband is not well, we have some access to the money on our line of credit, what should we do? And oftentimes we'll say, well, now would be a good time to access that.
Right.
Because they might not get it after he passed, but no
Right.
one's asking that younger spouse to leave the home.
Right.
So for in those situations, a reverse mortgage is great for them.
And the younger spouse is on the deed?
Yes.
Okay, excellent,
Needs to be
excellent,
on the deed. That
excellent.
sounds good.
You know, go ahead, Janice.
Okay. Well, how about the fact that I really don't want to make any, I know I've got some repairs, okay? And I don't want to really deal with that whatsoever. I mean, I've taken care of some of it already, but I know that there's going to be more repairs. So I don't necessarily need the money right now, but is there a way that, I mean, you can just put the money there so I have access to it, you know, or even the fact, when I say I don't want to pay anything, I mean I don't want to pay property taxes or insurance. Is there a way I can just set it aside and you guys take the money out because I got the money. You already gave it to me.
I love that you're loading me up with a whole bunch of questions with one question. You snuck a whole bunch in
That would
there.
be me.
So first on the repair thing. So these are our FHA loans, and so they do need to meet an FHA appraisal. Now this FHA appraisal is no different than the 30-year fixed FHA appraisal.
Okay.
And so it is, you know, basically is a home habitable, you know,
Sure.
in conditions, but it's not a special reverse mortgage thing. So if there has to be repairs, then we'll address that either through the appraisal or prior to closing, or with a repair escrow. Now, part of those repairs, sometimes people use repairs and renovations as the same thing. This might be a great vehicle, the retirement mortgage, in which to make modifications to the home as we've aged.
Yes.
And so, again, it's why take money out of your savings account, your investment accounts, and so forth to build this ramp, to add on a special room or so forth that someone else might get care in. So why not use the equity to then do that?
Right.
And so we see that a lot because people move the utilities from the basement
Absolutely, to
upstairs
upstairs.
because some of us have old knees. And so this is another great tool in order to do that. And then as far as making a payment for taxes and insurance, we call that a LISA. It's a life expectancy set aside, and it's not an escrow account, but it kind of acts like that. What we do is we put a hold on the line of credit. These are
Okay.
typically set up as line of credit, in which those payments can be made. Typically those are set up for individuals who might have had some trouble in the past making those payments. So we would rather have them have access to the line of credit so they can use it, and we teach them how to access it, or we can set it up to do that.
Okay.
So with a reverse mortgage, if you think about part of your question, they have the ability to pay the payment or to pay off the mortgage, which had a required payment.
Right.
Maybe even set it up so they get money each month. They could turn around and use that access to then also pay taxes and insurance. So now their Social Security income is not being tapped in any way. The house paid for the old mortgage, the house is paying for the new mortgage and taxes and insurance.
What is the required credit score for a reverse mortgage?
Oh, that's easy, there's none. So
you guys don't care about my credit?
we do care about it. So what we look at is primarily how you've paid your taxes and insurance over the last 24 months. We do look at how you've paid the other debts. And then so in that case, that's where it goes back to that LISA, that life expectancy set aside. If we do think that there might be an issue with that, then we would require that to be held on there. But there's not a credit score criteria.
Excellent.
Yes.
Let's talk a little bit about using a reverse mortgage to buy a home or build a home.
I like that one.
Well, and so with this, right now we talked about seniors sitting on a lot of equity. So there are a lot of seniors that don't realize that they can leave the home that they're in now that doesn't fit their retirement needs. And so they're sitting on this home free and clear. Let's just say it's a $400,000 home for an example, and trying to find another one. Well, homes have gotten more expensive, and so
Right.
maybe they can't find a comparable home for $400,000. We'll just pretend that's the case. So with a reverse mortgage, even if they did find a $400,000 home, they sold the one free and clear. They now find another $400,000 home that better fits their need. They might only have to put 50% down.
Right.
So now they've put 50% down. They have no required payment other than taxes and insurance and HOAs we discussed. Now they have $200,000 burning a hole in their pocket. And so that can be used for long-term care. And I actually have a situation similar to this. Retirement needs, take a trip.
Yeah.
To give to family members, to give to charity. And so they're in a home that better fits their needs, still have no payment, and now have cash to use to have a better retirement. I have someone very much like this. They have a basement, with utilities downstairs, the house needs some repairs, and so that's what they've done is they've sold this home for about $320,000,
Yeah.
buying a $300,000 house. They're happy, the financial planner's happy. It's a ranch versus the 3 stories they would have otherwise.
Absolutely.
So yes, they can do that. And so we're trying to educate realtors that their inventory is out there. We're trying to help them educate home buyers they didn't know could buy because they're sitting on a home, maybe free and clear, with Social Security, and they don't know they could have a better retirement if they use, we call it the HECM for purchase or H
Sure.
for P. They could just, everything would be better for them.
Yes.
And especially in a rising rate or rising home values, they don't think they can afford it. So even if they did sell this $400,000 home, free and clear, now maybe we're talking about a $600,000, $700,000, $800,000 home, which theoretically would be nicer, and all they have to do is pay taxes, insurance, and HOA.
It's a heck of a deal.
Yeah, it is.
It's a heck
It
of
is
a
a
deal.
secret.
Yes, it
Yes.
is a best kept secret and a heck of a deal. So also for some buyers, I mean, they're homeowners, they have very limited income. But maybe they do have a nice savings. Maybe that's $100,000, right? So they know they have that as a cushion. Their home is free and clear or very low balance. It sounds like a reverse mortgage, and they might be pinching off this $100,000, right, to make things meet. But they have equity in their home, right?
Yes.
You follow me, this example?
I'm almost thinking you're looking at one of my past files.
Okay.
Because how you line that up was we'll say her name was Debbie.
Okay.
Was a lot like what you're describing. So Debbie retired perhaps a little bit earlier than what she should have, as she was told by her financial advisor, who then recommended that she get a reverse mortgage, because what she was doing was tapping into her $100,000 to continue to make the payments.
Wow.
And so then, so we got involved with it. And what she had to do, she was pretty close to where she needed to be, but she needed to bring a little bit of money. And so we talked with the financial advisor and said, look, the amount of money she needs to bring is really what she's going to pay over the next 6 months.
Yes.
So we taught her that all she's going to do is make the next 6 months of payments to buy down to where she needs to qualify.
Right.
That monthly payment goes away. She can stop tapping into the $100,000 that's quickly dwindling on the path that she's going, and be much better off. And she can't be any happier about this, because now that burden's gone. The financial advisor is thrilled because he's doing the right thing for his client. And what we did in this case is Debbie will spend the money. So we've educated her to make an optional payment, because if she has the money in her account, she's going to spend it.
Okay.
So each month she's paying about $200, and then we've taught her that every 6 months we've taught her how to take the money out. So she's already setting aside taxes and insurance to pay for that.
Right.
And so it's kind of, she was used to making the payment anyways.
Right.
Right.
And now it's
Right.
substantially reduced.
Yeah.
So, but that
Peace of
helped.
mind.
Peace of mind.
Peace
She
of
cannot
mind.
be any
Yeah.
happier that we've eliminated that payment and held on to the $100,000 that now might be needed down the road for healthcare reasons or other things.
This may not have anything to do with anything, but I'm just wondering. So if I took out, here I'm making the example. So I'm on the deed. Can your children still be on the deed?
No.
Okay. Okay.
But that doesn't mean, what we do want is for individuals to be talking to their other professionals
Right.
to make sure that they have their plans in place.
Sure.
And so
sure.
how is that home going
But they
to be
don't want the house anyway,
that happens. That
yeah,
used to
I know
be a
it does
thing.
happen. Now a lot of
Yes.
I hear that all the time, where the senior citizens saying, "Well, my kids don't want the house.
They don't
just
want
said,
the house.
They'll sell it, or something of that nature." But in this case, I mean, a lot of times their names might already be on the deed. But I did want to ask that about the reverse mortgage. That could anybody else be on the deed? So okay.
When it comes to, and we've got a couple of minutes, so I've got 2 or 3 questions I'd like to get answered. Let's say I'm 65. I'm still working. I'm 65. I'm in a great space equity-wise with my home, but I still have a mortgage payment.
Right.
And I've got a 401k account. Okay. And I can make my monthly mortgage payments because I'm still working comfortably.
Why?
Right.
So if you're over 62 and you have equity, why make a payment?
Yeah.
I mean, especially if you're not moving. So what you're doing in that example is you're continuing to put money into the house and you're trapping that money. So why not make that payment optional? Why not put it into your other accounts so that you can tap into it, or use a reverse mortgage? We have individuals that would get a reverse mortgage before they need it, because what's unique about these is they're set up on a line of credit. Whenever you have money available on your reverse mortgage to borrow, it's going to grow. Whatever the prevailing rate is, whatever you might be paying on what you borrowed, a unique feature is it will get bigger over time. So in your example, why continue to make a payment? Why not have the line of credit that will grow and have a better retirement?
Viewers, all I can tell you is we have so much more to share with you
We do.
about
We do.
the reverse
And I still have
mortgage.
questions.
And Janice has questions. And one of the things Rock just said is, like, if you are intending to live in their house, let's say you're there already and this is where you're going to stay.
Exactly.
As you're making more payments, like I like the term he used, you're just trapping your equity in your house. When in fact you could be taking that equity and potentially putting it under a reverse mortgage, or using a reverse mortgage to actually improve your quality of life and use your other cash, in other words, ways, whether that's investment or whatever. But we have 14 seconds. And it's been a hoot.
It has.
And we appreciate you, Rock. Thank
Rock.
you so
Yes,
much. We want you to
yes.
come back.
Sure.
Please do.
You guys have a wonderful day. Wonderful day.